Welcome to the Capital News. I am your host, Alex Karitis. Today is April 16th, 2019. Thank you so much for joining me. I hope everyone is doing well out there. Let's get straight into some of the market news. The S&P closed up a whopping 1.5 points. The Dow was up 68 points for the day. The Nasdaq closed up 24 points. And the Russell 2000, the small cap index, closed higher to almost 4 points for the day. Oil, at the time of this podcast, is at $64.45 a barrel, so it breached the $64 level once again. Gold took a beating today and is pretty south of our $1,300 benchmark and now sits at $1,278 an ounce. Silver also remains below our $15 benchmark and now sits at $14.96 an ounce. Meanwhile, the 10-year U.S. Treasury increased by 1.5 percentage points today and now sits at 2.592%. That's 2.592%. Meanwhile, the VIX, the volatility index, decreased by another 1 percentage point and now sits at $12.18. Now, obviously, we are still in the midst of Q1 earnings season, right? Very much so. We've been having the discussion that's been pertaining to the financials. They were the first really to kick off earnings season, and we were discussing J.P. Morgan Chase. We were discussing Wells Fargo, Citigroup, Goldman Sachs. You had the darling of Wall Street, J.P. Morgan, which just beat and everything was stellar and fantastic. But then you are starting to see the other banks. Yeah, they might have some record profits, but, well, what's the forward guidance? What's going on here? What's the profitability? Are we cutting costs, but what's revenue, right? We were having that discussion yesterday, and it's important because that was the piece of the puzzle that we've been discussing here at length, especially all in relation to a lot of the corporate debt that we've been discussing, right? Whether that's the issuance of corporate bonds, whether that is commercial and industrial loans, whether that's leveraged loans, which again is a loan on top of a loan. And in some cases, I'm sure it's loans sitting on top of a loan, sitting on top of a loan. And just continue that out for some of those companies out there. I am sure of it. So what does this all mean? This is what we have to be mindful of. Not only what are the earnings, what are the revenues, but what is the trend and the guidance going forward. And even as we look at the numbers now, in the first quarter of 2019, what are we witnessing? Well, we know so far that we continue to see record banking profits. So again, if you're somebody who is asking the question, well, aren't we draining the swamp? Well, my answer to you would be no, because you have record profits in the banking system. You have record profits and revenues, again, in the banks and also within the military-industrial complex. So when you're talking about the likes of Boeing, and we talk about Boeing at length here, especially in regards to their recent negative news, obviously, which would be negative for anybody when you have an airliner go down, a couple accidents over the past several months. It's not going to be good for anybody. So these are the issues that are facing us here when we're supposed to be, quote-unquote, draining the swamp. Well, it doesn't look like it. Again, we do not demonize profits here. I'm a libertarian. I'm a free market capitalist. I'm laissez-faire. Let it be. Let it ride. Stay out of my business. I'll stay out of yours, and that's just how it works. But I have a problem when we have a fraudulent system, when you have fractional reserve banking, when you have a Federal Reserve that prints funny money like it's going out of business, going out of style, because it likely is going out of business and going out of style. This is what happens. This is where the money goes to. It goes to those who are most well-connected. It goes to the owners of the Federal Reserve, which are these major banks. That's where it goes. That's who they're going to look out for. It was only a decade ago, folks. These are the players that got bailed out. You didn't. You lost your job. You may have lost your house. You may have lost your vehicles. Due to the financial stress, maybe some of you even lost your families, unfortunately. So you don't get bailed out. And in fact, any money that you have, any of the tax dollars that you're sending to Uncle Sam that he's still taking from you, went to bail out the people who screwed the system. I mean, you can't make this stuff up. And now they are becoming wealthier and wealthier and wealthier. And again, I don't demonize wealth and profit. But when it's done fraudulently, I have a huge problem with that. And that's what people need to understand and wake up to the fact that we live in a very, very fraudulent system. We talked about that when we were discussing Ray Dalio, the hedge fund manager who posted his article out there. We had that discussion, which I am not done with, by the way. We had a couple comments on that, but there's still a lot more to go on that, but there's just been some other news. We're in the midst of Q1 earnings season. There's a whole host of other things. And given the fact that Ray Dalio's argument with inequality and his argument of capitalism needing reformed, that's what this program is all about, talking about free market capitalism. Again, Ray Dalio, I respect him from his business and investment acumen and his passion, I believe, for financial and economic history and sort of conveying that to the general public, at least more now so than he did previously. I applaud him and his team for that, but he is wrong here when it comes to saying that capitalism needs reformed. No, sir, capitalism needs reinstated. That's the whole problem. Funny money, printing presses is not capitalism. It's not. It's not. It's a sick and twisted version of corporatism or fascism, whichever word you want to use, with a big dose of socialism. And again, socialism, fascism, communism, they are all the same thing. There's just different styles, but it's all the same end goal. It's all control. It's all manipulation. It's buddy-buddy with either the government delegating to corporations and being joined at the hip, or it's actually the government being in charge. So you have a host of those things in this country. Where's free market capitalism? It's getting smaller and smaller and smaller and smaller, if it even exists anywhere in this country. There might be some tiny tidbits here and there, but it is not the majority of this economy, and that is unfortunate because the fact that you have the twisted hybrid of corporatism and socialism, that's why you have all of these problems. I talk about it all the time. You want to start solving these problems? You want to get real? And the Federal Reserve abolish the income tax. Then you will start to starve the beast, and then you can start allowing people to keep their money. Wow, what an idea. People go to work and they're allowed to keep all of their money? Good idea. Let's institute a sales tax on new items. You can control your tax bill that way. If you don't want to spend your money on new items, if you don't want to buy a new house, you want to buy a used house, you don't want to buy a new car, you can buy a used car, you can avoid some taxes. So you are better in control of your tax bill. Right now, Uncle Sam just takes it from you. And then you have to go into debt up to your eyeballs just to make ends meet. 78% of Americans living paycheck to paycheck. How is that in the midst of an economic miracle? Most Americans don't have $400. They couldn't come up with $400 in the event of an emergency. How disgraceful is that? But no, everything's fine. Don't worry about a thing. Don't worry about a thing. Some of the other companies that I want to discuss today, we still have some financial firms that are out. We had Bank of America, also BlackRock, which is a just mammoth of an investment house. I think they just, again, grew their assets under management above $6 trillion, $6.5 trillion, I believe it is. And then also Netflix. And the reason I want to talk about Netflix is because Netflix it comprises FANG. You know the FANG stocks, if you watch the financial media, FANG, F-A-N-G, that's the big news. That's always a talking point. And that's comprised of Facebook, Amazon, Netflix, and Google. Sometimes the A is a double A. Sometimes it has to deal with Amazon and Apple. But these are basically the stocks that really led the charge, well, almost for the past decade. So my thinking is if these were the leaders to the upside, these will probably become the leaders to the downside as well. And we started to see this back in the fourth quarter of 2018. I imagine at some point this will happen once again. They will roll over. There will be smaller margins. There will be something that we have to pay attention to in these earnings calls and these earnings reports. And that's why I'm bringing this to your guys' attention. So in regards to Netflix, here's what we have, and just let me read some of this to you here as far as their earnings are concerned. So Netflix reported first quarter earnings of 76 cents a share versus Wall Street analyst estimates of 57. So they knocked it out of the park on the earnings side. Net sales clocked in at $4.52 billion, slightly above forecasts for $4.5 billion. So they beat on the profit side, and they also beat on the revenue side. That's good. Netflix added 9.6 million total new subscribers in the quarter. That's up 16% from a year ago. Analysts estimated 8.94 million new additions, so they blew that out of the water. Good for Netflix. Nevertheless, Netflix shares dropped as much as 4% in after-hours trading after they reported their earnings. I don't think it's down 4% right now as I'm reading this off to you, but I think they did recover a little bit. But nevertheless, they did drop off 4% following the earnings call. But there were some warning signs ahead. Let me read these to you. Netflix sees a deceleration in new subscriber additions in the second quarter to 5 million. So that's quite the drop from 9.6 million down to 5, while Wall Street was expecting 6 million for the next quarter. Sales growth slowed for the fourth straight quarter, so that's not good. Operating profit margins fell 190 basis points from the prior year, so that again goes to our point of something that we have to monitor closely during Q1 earnings season. What are the operating profit margins? Because this is the money that these companies have to spend on investing in the company or paying off their debt, and if these margins start to get squeezed, these companies are going to start to get in trouble, especially the ones that are debt-ridden. And we know that story because we talk about that at length here. The year-over-year growth trend in paid membership also continues to be lower, so that's not great for them. And then at an outflow of $460 million in the quarter, Netflix burned cash at a faster rate than the year-ago quarter, which was $287 million. So they burned through $460 million in the first quarter of this year compared to $287 million in the first quarter of last year. So quite the difference. But nevertheless, I think probably a lot of that probably has to do with new content generation. Look, we had the discussion last week in regards to why the Dow really rallied a couple hundred points. And that had to do with JP Morgan, had to do with Boeing, but it also had to do, recall, with Disney coming out with their streaming service. Again, I think this is a different market, different demographic, but nevertheless, it will have some competition against Netflix. It's going to take time, despite the fact that Disney is a household name, but you also have some other streaming services and other things out there. But I really don't think Netflix is in any major danger from competition, so to speak, at this point. It doesn't mean that the share price isn't overvalued. I mean, this thing it's just taken off to the moon. It's just it is a darling of Wall Street. Investors just love it because it's Netflix. Everybody has an account. They know what it is. A friend, a family member has an account. Everybody knows what it is. Everybody is disgusted with their cable or with their dish service. And so what are some of the other opportunities out there for people to get involved with some other service, right? I mean, you're not going to get a lot of news and obviously a whole host of other stations, but maybe you just like certain programs. Maybe you just like movies or whatever the series might be. And Netflix is really coming out with a lot of good content. So I don't really foresee them being in a whole host of trouble. But nevertheless, it doesn't mean that the forward guidance isn't going to, I don't want to use the word decimate, but have a downside effect on the share price. I mean, just because Wall Street loves it today doesn't mean they're not going to hate it tomorrow. But I think that would be over the course of time. I mean, people love Netflix. There's no ifs, ands, or buts about it. They have a huge subscription base. They have increased their prices. So we'll see how that plays out moving forward. But that's all good news if they can pass along higher prices to their subscribers without losing a lot of them. And if they can do that, then they're probably going to be just A-okay because they have I don't even know what it is, 100 million subscribers worldwide, and it's growing, obviously. I mean, just the slightest of increase in the monthly subscription price generates a lot of revenue. So, but nevertheless, we're going to keep a lookout on these because this is part of the FANG, Facebook, Amazon, Netflix, Google. So if these guys led it to the upside, the market's to the upside, it's likely and logical that they will lead it to the downside. So we're going to pay attention to what's going on with those stocks. Next, we have Bank of America. So again, another financial, one of the major banks here in the United States, which again was bailed out while you were not. So, according to CEO Brian Moynihan, he says the following: economic growth and consumer activity in the U.S. continue to be solid. Businesses of every size are borrowing and driving the economy, and asset quality is strong. So here we have another bank CEO who must be jockeying for a position within the Trump White House that's saying everything is fantastic. We know otherwise. Now, what do we have here? The consumer and investment banking giant posted record earnings per share of 70 cents compared to 62 cents in the comparable year-ago quarter. So record profits for Bank of America as well. Bank of America saw revenue of $23 billion versus the prior year-ago period of $23.1, so slightly downward. Analysts on average expected the bank to report 66 cents on $23.1 billion of revenue. So they beat on earnings. They were a slight downtick on revenue. Again, something that we said to be mindful of, that you might have higher earnings, but you might start to see a deterioration and a slowdown in top-line growth, revenue growth. Because if that's the case, then you don't have that strong of a consumer or investment market out there. That's how these banks make their money. Now, despite the sentence that I just read you in regards to what CEO Brian Moynihan saying everything is fine, here's what the CFO had to say during the earnings call as well. He says he was raising, I don't want to use the word alarm bells, but he was warning on slowing loan growth this year. The CFO of Bank of America warned on slowing loan growth this year, raising concerns about whether the company's blockbuster growth was sustainable. So were these guys not prepared before they gave their earnings call and made these statements? On one hand, you have the CEO saying everything is fantastic, everybody's borrowing money. We know everybody's borrowing money because they don't have any cash coming in, so they got to go to the bank to get it. Now, are there some small businesses out there, some medium-sized businesses, some large businesses out there who are growing? Absolutely. Absolutely there are. But we know you can't look at the data of the number of bonds that are outstanding on corporate balance sheets when you look at the commercial and industrial loans out there, when you look at the leveraged loan market out there, that this is all good. It isn't. They need the money to kick the can further down the road. That's all this is. This is a lot of financial engineering. Are there companies, again, that are doing well? Yeah, there always are companies that are doing well, no matter what the environment. That's just what they are. There's some companies that are going to thrive even when things go down. That might even be where they make their business when things are going to the downside. So somebody's always going to be doing well. That's never going to be argued otherwise here. So it's just fascinating to me. I'm not surprised, by the way, but it's just something else where you have these statements at odds with each other, basically in the same earnings call. Everything is fine and fantastic. Businesses of every size are borrowing and driving the economy, and asset quality is strong. That's what the CEO said. Then the CFO says, well, loan growth is going to slow down this year. Well, if everything's fine, why would it slow down? Just have a party. Just keep loaning and borrowing money. What's the problem? So something's at odds here, right? Nevertheless, the Bank of America, their shares they didn't really outperform at all today. They opened lower, didn't really move around too much today. But it's beyond the point. It's just getting ridiculous. But that's where we are. Next, we have BlackRock. BlackRock is a major investment fund company. Again, $6.5 trillion in assets under management, so they're huge. Okay. They posted earnings of $6.61 per share, down from the comparable year-ago period of $6.70. Revenues were $3.34 billion, down slightly from $3.58 billion in the first quarter of 2018. So they didn't outperform on either on a year-over-year basis. Now, they beat expectations on the profit side, but that's expectations of analysts. That's the average. So some of them probably got it right, some of them didn't. So, I really don't give a lot of weight to these analysts because they're rarely ever right. There's always upward surprises or downward surprises. However many of them ever hit it right on the head. None of them. If it is, you're lucky. You guessed. A broken clock's right twice a day. Pick a number, any number. You could do it. You're just not going to be paid 6 or 7 figures for making a lucky guess. So, I don't put a lot of weight in this, but you have to pay attention to it because the markets do. And that's what it is. So, BlackRock, despite the fact of increasing their assets under management to $6.5 trillion, their earnings were worse than last year. The revenue growth was worse than last year. Now, another point that was just made in an article because it was sort of tying everything together that we've been discussing here as well with the earnings of Goldman Sachs and Citigroup and Wells Fargo, everybody, right? They said the following in this article. It said, taken together, this again is with the banking and financial industry. Taken together, they suggested the Federal Reserve's pausing of interest rate hikes was beginning to undercut banks' profitability. So here we have it, folks. We just talked about yesterday with the president out again on Sunday attacking the Federal Reserve, saying they need to lower interest rates. They need to embark on quantitative easing number 4, maybe even more, blaming the Federal Reserve for increasing interest rates as many times as they did under his administration, saying that the stock market, the Dow Jones Industrial Average, would be 5,000 to 10,000 points higher. GDP growth would have been higher than 4%, not the 3% that we got. So he's out there bashing them. And again, there's only one of two things that's going on here with the president. He's either dancing himself out of the box that he's placed himself in by taking ownership of this stock market and this economy. And now if things go south, either in the economy and or the stock market, he doesn't want to hold the bag. Poor leadership, but that's what he's going to do. He's going to take credit for it if this thing makes new highs, and he's going to blame the Federal Reserve if it goes down again. That's what he's going to do. Bet your last dollar on it. The other thing that might be the case, so he's either dancing or somebody within the White House or somewhere has his ear and has convinced him that no, that is actually the best policy for the Federal Reserve and for the United States at large. It is not. It is not. And if he keeps pushing that, and if I think that the president actually in his heart believes that that is the best policy for the Federal Reserve and for the United States, I will not vote for him in 2020. That's how important this issue is to me, because I understand the problem. So if he wants to blame the Federal Reserve, I'm fine and all for that, like we said, and the Fed. But if he actually has been turned somehow, or somebody there has his ear and says, no, we actually have to cut interest rates, the Federal Reserve has to go back on quantitative easing, that's a big no-no, and I'm not going to tolerate that. So it's interesting to see how the banks are at least stating in some of their earnings, look, we have revenue problems here, we're slowing down. Yes, the earnings were up, but I mean, that could be at the cost of laying people off, not paying them as much. The bonus pool gets shortened, So it's interesting to see what's going to happen now. What's the Federal Reserve paying attention to? Are they really independent? I mean, are they going to cut interest rates? Because then if they do that, or if they embark on quantitative easing number 4, are they independent? Because that's what President Trump, Larry Kudlow, Steve Moore are calling for. People within the White House, including the president, are calling for the Federal Reserve to act in a certain way. If they act that way, it's really going to call into question their independence. Oh, you're just a lapdog for the White House and for President Trump. It's an election year. Oh, you can't have the stock market going down. You can't have the economy going down because you're raising interest rates. You can't do that. So it's all political now. They were supposed to be independent. We know that's a bunch of bull, but that's the argument that they make to the public. So that's going to come into question. So the president, if he's trying to box himself out, he may be boxing the Federal Reserve in, because now you have the banking sector that does not have stellar or blockbuster reports coming out. I mean, they have record profits, but their earnings are starting to slow, and the forward guidance is not that great. So are they going to say, well, Federal Reserve, come on, you got to increase those interest rates because that's how we make our money. We're banks. We lend out money. We need higher interest rates. We can get higher spread here, make more money. Let's go. So what's the Fed going to do? They're going to listen to Trump? Are they going to listen to the banks? They're just going to remain and wait and see? This is where we are, folks. This is the politicization of everything. This is why everything is messed up. This is why we were in the financial world of Oz. This is why we were in the political land of Oz. And again, this isn't markets. When you have a White House, a central bank, moving markets to the length that they do, it's not a market. It's not a market. So tread very carefully if you are in these markets. If you don't have a stomach for volatility, you might want to get out. You might just want to say, I'm just going to watch this freak show from the sidelines, and it's just going to be my entertainment. But if you have the stomach for the volatility, by all means, do what you think's best. But have a plan for the upside and have a plan for the downside. Thank you so much for joining me today, ladies and gentlemen. It's been a pleasure having you. As always, please like, share, subscribe, get the word out, leave your comments. I'd love to hear from you. This is the Capital News. I am Alex Karitis. Godspeed.